Imagine this. You're a seasoned investor in the late 1990s. Decades of experience. You survived crashes, recessions, bad CEOs, and yet you're about to pour millions into a company that has no profits, no clear business model, and sometimes no product at all. Not because you're stupid, but because saying no suddenly feels more dangerous than saying yes. That's the dot-com bubble. And the uncomfortable truth is this: it wasn't driven by amateurs. It was driven by smart people doing very human things. And that's why it matters right now. Because whenever a new technology promises to change everything, the same psychological traps quietly reappear. Different decade, same wiring. Let's rewind. In 1995, the internet was still clunky, slow connections, ugly websites. Most people didn't even know what a browser was. But something undeniable was happening. Email worked. Online shopping worked. Information suddenly moved at the speed of light. This wasn't a fad. This felt like electricity or railroads. And Wall Street noticed. At first, investors were cautious. They asked normal questions. How does this company make money? When will it be profitable? But the answers kept changing. Not yet. We're focused on growth. Profits come later. That was new. Historically, companies grew after they made money. Now they were making money optional. And oddly, the market rewarded that. Netscape goes public in 1995. The stock doubles on day one. No earnings, just potential. That single event flipped a switch because suddenly investors weren't valuing companies based on what they earned. They were valuing stories. How big could this get? How many users could it have? How fast could it scale? And here's where the system quietly broke. Traditional valuation is boring. Cash flows, margins, balance sheets. But the internet promised something intoxicating. Infinite scale with near zero cost. If software can be copied endlessly, if websites can serve millions, then old math feels obsolete. So new math was invented. Price to earnings became irrelevant because there were no earnings. Instead, analysts used things like price per click or price per eyeball. And nobody asked the obvious question: what happens when eyeballs don't pay rent? Here's the irony. Many of these investors knew the numbers didn't make sense. They could see it. But markets aren't driven by logic alone. They're driven by careers. Imagine you're a fund manager in 1998. Your job isn't to be right long-term. It's to not look stupid short-term. If you avoid internet stocks and they keep soaring, clients leave. Your boss asks questions. But if you buy them and they crash, well, everyone else crashed too. This is called career risk, and it's powerful. So even skeptics participated, quietly, reluctantly, but fully. Money flooded in. Startups realized something shocking. Profits were optional, but hype was essential. So they spent aggressively. Super Bowl ads, free services, growth at any cost. The goal wasn't sustainability. The goal was to go public before reality arrived. And Wall Street helped. Investment banks made billions underwriting IPOs. Analysts promoted stocks their firms were selling. Conflict of interest wasn't hidden, it was normalized. The system fed itself. Retail investors saw prices rising. They didn't want to miss out. Media reinforced the narrative. This time is different. The old rules don't apply. We're entering a new economy. Those phrases should always make you nervous. By 1999, things got absurd. Companies added .com to their name and their stock doubled. Pets.com became a symbol of the era, selling dog food online with shipping costs higher than the product. But the investors didn't care because the stock was going up. And rising prices create their own justification. If something goes up, it feels validated, even if nothing underneath has changed. That's the hidden mechanism. Markets don't ask, is this true? They ask, is this working for now? The uncomfortable math arrived quietly. Burn rates were enormous, cash was evaporating, revenue couldn't catch up. But as long as new money entered the system, companies survived. Until it didn't. In early 2000, sentiment shifted, just slightly. Interest rates ticked up, a few earnings disappointed, and suddenly the story cracked. When prices stopped rising, the spell broke. Investors looked at fundamentals again and didn't like what they saw. The exits were crowded. The Nasdaq fell nearly 80%, trillions vanished, companies disappeared, jobs vanished, retirements vanished. And the most painful part? The internet didn't fail. The technology worked. The mistake wasn't believing in the future, it was paying any price for it. That's the paradox of bubbles. They're built on something real, but inflated beyond reason. And smart investors fall for them, not because they're ignorant, but because they underestimate one thing: human behavior under uncertainty. Zoom out. The dot-com bubble wasn't about websites, it was about incentives, about stories overpowering spreadsheets, about short-term rewards dominating long-term thinking, about believing that speed replaces discipline. Those forces didn't disappear in 2000. They never do. Every generation believes it's smarter than the last. Every boom claims unique logic. Every collapse feels obvious in hindsight. Which leads to the final uncomfortable question. If you were there in 1999, with your peers getting rich, with experts reassuring you, with charts going straight up, would you really have stayed out? Or would you, quietly and rationally, found a reason to join in? That question matters more than the history. Because bubbles don't announce themselves. They feel like progress. And by the time certainty arrives, the opportunity is already gone.